So I recorded. So today we're gonna talk about, which is the last part, or the last item, the last content we're gonna cover in this international finance course, is to how to estimate international cost of capital. International cost of capital here would allow us to decide whether or not or how that affect to decision from the perspective of equity holders. Okay, so before I go for that, I think we have one question that we skip it at the moment, but we're gonna use it to identify so that we would that would allow us to make some scenario and sensitivity analysis for analyzing, including the one that we did yesterday on debt financing, on valuation of credit risk, the probability of default to get whether or not the investment grade rating. So we just yesterday discussed about base case, and now we have to probably need to do some sensitivity analysis by allowing some factor to move. But before we go for that, we need to identify different type of risk, and then try to find out what type of risk that may affect the economics or financial cash flows of the project, that would affect your DSCR calculation, that would affect your equity, cost of capital, or your IRR, and so on and so forth. Okay, so I would probably go and give you just 1 second. Just 1 second. I have okay. Oops. Okay. Share the screen with you. Oops. Okay. All right, we go to the 10A. Everybody has your Excel spreadsheet ready? Yes. So, would you use your Excel spreadsheet and calculate your IRR of the base case? IRR we're talking about here is the IRR of equity. Okay, which is had taking into account of, which is different from the IRR of a project, right? IRR project should not affect for, these have something called effect with effect of capital structures. Okay, so we use the IRR. So how we compute the IRR of equity? So we use the what? We use the free cash flow of equity, right? So when you use the IRR of the projects, okay, so we don't take into account without the effects of capital structures. So we use free cash flows of the projects. And when we know the project, we assume that the project, finance everything by equity. Okay, so the IRR of the project, okay, is like a IRR of firms. Okay, you should use the free cash flow of the project. Where you use the IRR of equity by taking only the free cash flow available to equity holder, meaning that after your debt payment, so these you have the effect from the capital structures, and then we're gonna be able to compute the IRR equity. Okay, after you get the IRR of equity, you're gonna compare with your R equity, right? So if everybody know what I'm talking about here, so everybody follows where this one you compare with the R of the project. This is a very common misunderstanding. Sometime when we're talking about whether what is the IRR, what is the R, how we make decisions. The idea what we want to do is from the DuPont or perspectives, we are interested to compare these IRR with the R of equity. Okay, so because you are interested about what is your operating cost of capital as an equity holder, you compare what the return the project provided to the equity holders. By the way, this one is the IRR equity, okay, which is 25.6%. Anyone know where you get this 25.6%? Can you do it by on your Excel spreadsheet? Whether you get 25.6%. So what you have to do is, as you can see here, the equity cash flows, you have the investment, okay? If you put in this Excel spreadsheet with negative 79,035, negative 1,982, 550,148. Basically, you combine this column and this column and you compute the IRR. Can you do it now in your Excel spreadsheet? You follow? So you put these in the same column, these two columns in one column, and then you use the IRR formula on Excel spreadsheet and tell me what is the IRR you get. Why don't you do it now? Please compute IRR equity of in Excel. What is the IRR you get? Anyone want to take the camera on? Everybody follows? You guys follows? So you use equity cash flows, okay? Where the equity, wow, Tonkin Tran, you get 25.58. Perfect. So you just combine the column where you have those, negative equity cash flows, meaning that the equity or project sponsor put the money in the project and the equity project sponsor get the dividend over time until the end of the project, right? So all the cash flow in and kind of cash flow out, you use the free cash flows from equity cash flows. So you're gonna get the IRR. In this one is the IRR equity, which is different from the IRR of the project, right? Because IRR of the project, if you remember your Olivier Kozak class, when we calculate the capital budgeting decision, we assume that all the equity, they're financed by equity, right? So the financing, financial expenses is not included, right? So when you calculate IRR of the project, okay, you calculate the NPV of the project, okay, we use the project's free cash flows. In the project free cash flow, we have cash flow from operation minus net investment and minus change in net working capital, right? So when you use the project free cash flow, you compute the IRR of the project. You assume that the project is 100% financed by equity. So if the project change the debt or capital structure, the capital structure would affect, does capital structure affect IRR of the project or NPV of the project or not? Does capital structure affect IRR of the project or NPV of the project? Everybody follow me? If a project financed 100% by equity, the same project, if you decided to finance with 50% by debt and 50% by equity. Everybody follows me? Yes, everybody follows? My question is, does capital structure affect IRR of the project or NPV of the project? The answer would be T. Chun-dong said yes, it affects. Others? You follow me? Does capital structure affect project's IRR or project NPV? Does capital structure? Yes, yes, yes. You think no? Yes, it's no. It should affect if you take Martin Miller, okay? So your investment decision on the left-hand side and financing decision on the right-hand side, they should have a separate decision. So when you evaluate projects, okay, when you compute the NPV, you compute the IRR, you don't take financing into account. Interest expense never taking into account. You remember when you do cash flow from operations and you compute the unlevered net income, and then you adjust depreciation and you take all those are the IRR of the project or the NPV of the project should be or should remain unchanged, okay, with your financing decision, okay, because that is what is Martin Miller's told us, okay, and it is true. However, when we are talking about the IRR of equity here, where you use the free cash flow equity Okay, when you use the equity free cash flow like the Excel spreadsheet you have just made, it is what? Is the equity free cash flow or the project free cash flows? The column that you just combine and compute 25 point, what? I even forgot. 25.58%. You use what? You use equity free cash flow or you use project free cash flows? You use equity free cash flows, where those equity free cash flows, okay, comes after debt service, isn't it? When you use the project free cash flow, your project free cash flow comes before debt service. Actually, they end up with the same result in general, but just only the equity free cash flows allow you to compute the IRR equity. Once you get IR equity, you have to compare with R equity, right? The R equity represent required rate of return to equity holder. You also taking into account of the extra risk where the equity holder bears after the capital structure decision. Follow me? Everybody follows? So if I compute IRR of equity, the IRR of equity should be bigger or smaller than the IRR of the project without debt. Should be higher or lower than the IRR of the project. IRR of equity should be bigger or smaller than IRR of the project. Should be bigger. Very good. Bigger or equal. If the project financed everything by equity, IRR of equity will be equal to the IRR of the project, isn't it? But if the project start to have debt, meaning that the equity or levered equity holders would require additional risk premium to compensate the additional financial risk that the levered equity holder bears. Okay, this is not new. I taught you, I discussed this in our capital structure class. Remember, Martin Miller, we're talking about levered and unlevered and so on and so forth, right? Unlevered equity holder, okay, will require lower rate of return than levered equity holders. In other words, levered equity holder will require extra risk premium to compensate the financial risk due to the additional financial risk due to the capital structure or due to the debt that equity or company or the project decided to have. Okay, so when you look at these, you can see here equity cash flow, when we're talking about dividend and investment here, all the equity cash flow that you derive here is come after the debt service, right? But if you derive the total revenue and you have other expenses and you have the free cash flows to the project free cash flow, you compute the IRR, you're gonna get the IRR of the project. You never take the debt service or interest expenses into account. But this one, you use equity cash flows. Therefore, your dividend and investment dividend come from after debt service. So therefore, when you compute here, you compute to get the IRR with equity cash flow. We call IRR equity. Everybody follows? Yes. After you get the IRR of equity, how you gonna make decision? You compare with the R equity, okay? Right? If the IRR of equity is bigger than the R equity, to what? What's your decision? Decision is you're gonna invest in the equity, right? You are equity holders, okay? You are invested, you decided to invest in equity. If you are a Conoco shareholder, you can invest in the equity in this company with the structure of debt, right? You have already taken your account of the capital structure effects, right? You invest in the equity only if the IRR of equity is bigger than your opportunity cost of capital with the same risk, okay, where the IRR of equity is bigger than the R equity, you invest in the equity. Up to now, so far so good. If I just want to check your understanding when you study the first finance class on investment decision. You compute the IRR of the project. That's right. You use the project's free cash flows. You assume that the project finance everything by equity or no leverage. You compare your IRR of the project with what? With the R equity? No. You compare IRR of the project with the R of the project. What is the R of the project means the project's opportunity cost of capital. With the same risk of the project, what would be the opportunity cost of that, right? So you compare of the IRR of the project, whether or not it's bigger than the R of the project, and then you're gonna invest in the project. You see the different, you see different comparisons and a different decision. Just only two things different. Okay, where when you use the project's free cash flows, okay, when you compute the IRR of the project or the NPV, you use project's free cash flow, meaning that the free cash flow available for both debt holder and equity holder, right? Oh, I love this. I love this class. I love to explain, challenge you a little bit to refine your understanding. Okay, because a lot of people don't understand this. When you do the project's free cash flows, you determine free cash flows available for both debt holders and equity holders, right? You don't use the same number, you don't use the same free cash flows. After you use the project's free cash flows, you are able to compute the NPV of the projects, right? We use NPV of the project, and then you decided whether the project you should go or not go. You accept the project when NPV of the projects is bigger than 0, right? Or the NPV or the IRR of the project is bigger than the R of the project, isn't it? Right? Meaning that the projects create value to the firm, meaning that to both debt holders and equity holder or to the capital providers, which is debt holders and equity holders. Yeah. All right. So we don't compare the same thing, right? If you use the capital, if you use exhibit number 11, let's assume that you know how to compute your cost of equity capital and cost of project cost of capital. In this case, we can assume that the RWAC represent the RU represent the project's cost of capital. If I compute the free cash flows of the project, I have to compare with 12.29%. If I compute the IRR equity, I gotta compare with the KE of 20.97 because this 20.97 already taking into account of the debt level, right? The cost of equity capital should be higher than the unlevered cost of capital. Follows? You did well in my capital structure class, I remember. So this is something not new, right? You know, unlevered compared to levered, right? Unlevered equity providers, okay, should not have the same required rate of return as compared to levered capital structure. The levered equity holder would require higher return than unlevered equity holders, right? Because of what? Because of the because of the because of the debt, right? Because the financial risk associated with that, right? With the increased financial risk associated with debt. Okay, and Marty Miller saying that it is exactly equal to the RU, RE equal to the RU plus E over E multiplied by RU minus RE, right now? RU minus RD, sorry. You know these Marty Millers that you have done perfectly in the exercise and the exam, but never mind if you forget all those. Okay, so but the concept is very important when you know see the case, when you read the information, you want to ensure that we're talking about what, right? We're talking about the same risk and you use the same benchmark or you use the same logic when you make decision or not, right? The decision for the equity holder in the company invested in the company with debt and in the company without debt, if both are the same company, they should not have the same required rate of return, isn't it? Okay, so if I use 25.58%, okay, and my 25.58%, it is right, so somebody help me to compute 25.58%. That is what? That what? What is 25.58%? 25.58%, you immediately, you know, think about what number is represents, right? The number represent equity cash flows. Equity cash flows. The equity cash flow meaning that the cash flow after debt. So therefore, this is the equity free cash flow. if you compute with the equity free cash flow, your IRR here would be the IRR equity. You compare, let's assume that 25.58%, you are able to compute the RE, or you can use the RWAC. Let's assume that RWAC is the RA, right? RWAC is the RA, and it's equal to the R unlevered, right? Is the average, the risk of the project. So you're gonna compare IRR equity of 25.58%. That assume that the Conoco shareholder estimate the cost of equity capital by using exhibit number 12. Okay, exhibit number 12, you're gonna compare 25.58% with what? Let's assume now you have number. You compute 20.97%, which is the KE, 12.29% is the WACC, and then the RD, I think something else. I forgot what is the RD. The RD is 10%. Okay. The RD is 10%, RE is 20.97%, RWAC is 12.29%. You compute 25.58%. You compare with what? You compare with 20.97%, or you compare with 12.29%, or you compute with 10%. What you should compare? You compare your 25.58% with compare with, anyone help me to type? You have to compare 25.58% with the KE. What is the KE? At least from this estimation, no? You compare it with 20.97%. Is it right? So you compare IRR equity with the R equity. IRR, you compute inside the project. You use equity cash flow, you get the IRR equity. You compare with the R equity. R equity, you observe outside to see what the equivalent risk to these equity holders, okay, when they invested in the company which has the similar risk, they require the 20.97%, where IRR of equity here is bigger than the R equity. So therefore, we say that invest or not invest. If you are Conoco shareholders, you're gonna invest in equity of this project. You see different decisions you have to make. Oops, you don't invest? You invest or not invest? You invest, okay. So you should invest, okay. Why you invest? Why you invest, Trong? Why you invest? Exactly. So you invest because the IRR equity is bigger than R equity. It means it investing in equity here creates value to equity holders. Okay, investing in equity here, I'm talking about investing in equity, right? Meaning that you invest in the project that have 60% leverage. Okay, so investing in equity here creates value to equity holders. That is how you interpret IRR equity, okay, which is bigger than the R of equity. Okay, so as you can see that when you IRR of the project should not change when changing capital structures. Unlike the IRR of equity, change when changing capital structures. Right? Everybody follows? The IRR of the project should not change when changing capital structure. However, IRR equity change when changing capital structure. If you want to compare whether the project is viable or not, financial viable or not, the project is a good project or not, right? It's not from the perspective only for the equity holders. It's just only the project itself is good or not good. You're gonna compare IRR of the projects, whether or not is bigger than the R of the project. In this case, I'm gonna use the R of the WACC as a proxy of the R of the projects. So you only have one decision to make when you compute the R of the project. You compare if it's bigger than the R of the project that I use R WACC as this proxy. Okay, since the R WACC is equal to the RU, is a R project here. So in that case, I gonna always say that the project is a good project or not, right? If a good project, and then you decide whether how you gonna finance that project. After you gonna decide that if you are the equity holder of the project, you can invest it or not. Depend on the, you know, IRR equity, whether it's bigger than the R equity or not, and so on and so forth. All right, so far so good. Yes. Wow, very interesting this morning, isn't it? Yes, always interesting. Okay, any question? I guess you may have questions. Please ask me questions if you have it. Should have question. Everything is so clear to you. I can have a lot of questions on today, this morning in your quiz, in the exam. Okay, very easy to. It's gonna be I gonna ask like IRR project should change when changing capital structure. You say false. IRR equity change when changing capital structure. Answer yes, like this. Okay. So if you understand this morning, you should be easy to get all this. Okay, which is actually not new. Huh? You have already learned it in my capital structure class. Did you take on my capital structure class? No, with me? Yes. Did you take it? Long time ago, Professor. You forgot everything. Yeah. Don't worry if you forget. But when you go with the real job, real world, think a little bit that, wow, I feel that I need to revise something. I need to check, think, because thinking is already good thing to do, right? You can question like, wow, what I'm doing, I calculate what, right? And then you can see, wow, this one looks strange to me if I compare my, IRR equity with the WACC, for example. What is the WACC represent? The WACC represent the firm's cost of capital, right? Firm of cost capital represent the asset risk is not the same of the risk of the equity holders. Those kind of reasoning is very important for you to think about it. The calculation is so simple to calculate, okay? But the interpretation of those number is more important than just only the calculations, right? Because the calculation, as you can see, you can get from Excel spreadsheet. Sometime when you do and get up some information from investment bankers, some people who prepare all those, you I would love you to be able to question and think, okay, before you just analyze it, because sometimes we go too fast, and sometimes I hope that all these you have learned already in our class, over the programs. Don't take it as a sunk cost and you forget everything. You have been already well trained, at least you learn something more. Just sometimes you forget to use it. And all the course you learn, all the content you have done is, you know, one day or another, it's gonna be helpful for you to think about it when you go and face the real practical problems, when you make a real decisions or you're part of the project team and so on. Now, the question is, I gonna go to see whether IRR equity is bigger than the RE for sure, or I have some risk that my decision, okay, as I know that my decision will be based on whether the IRR equity is bigger or not than the RE. But what I'm not sure whether my IRR equity I compute well, or my RE I compute well or not, right? Because my decision may change if I make some errors on my RE, or I make error on my RIRE, right? The only thing I want to make sure as a manager for this project is I would like to have to ensure what? To ensure that IRR equity, worst scenarios, worst scenario mean IRR equity minimum I should get should be bigger than the RE what? Maximum. Everybody follow me? You follows? We're gonna do and make the estimation, the range of IRR equity, and my IRR equity, if I take the pessimistic scenario. Everybody follows? Pessimistic mean that the project will generate a minimum, okay? But if it's still bigger than the RE, in this case, I'm gonna take the maximum scenario because that is the cost of equity capital I would expect. So if the IRR equity minimum is still bigger my RE maximum. In this case, it is I'm happy and I know that I gonna invest it for sure. Everybody follow me? So therefore, my final decision should be based on that my minimum scenario of my sensitivity analysis on my IRR equity should be bigger than the RE maximum. Unlike my IRR of the project, I compare with the R of the project. I don't need to put minimum or maximum, right? I just want to get the IRR of the project. You should have only one number. R of the project should be one number. But you can do almost the same thing that if my IRR project minimum is bigger than the R of the project maximum, in that case, I always find the value creation of the project. That makes sense to you guys? Yeah, does it make sense? Is it like yesterday? We are interested about what? We are interested about lowest DSCR, not average DSCR, right? Because the lowest DSCR represent the highest credit risk because it represent the highest credit risk. When you are taking from the perspective of the lender, you are very pessimistic guy, right? Anyone work in the bank, we know that when the banker, any banker who work in the credit department or lending, you never invest with them. They are very pessimistic person. They cannot be a very good entrepreneur. Very difficult for them because they're always thinking about the worst scenario where the borrower cannot pay their debt obligation, isn't it? Sometimes it's a joke, huh? It's not 100%, but in general, for example, if you are going to do business, if you take a banker, who has been working on the credit department or loan department, always very difficult to convince them because they don't like to take risk. They are a very risk averse person, isn't it? And you are going to do business, don't take the lawyer as your partner. Use the lawyer to advise you, but don't invest together with the lawyer because the lawyer, by definition, they are very risk averse person, isn't it? When you do business, don't do a joint venture with a finance professor like me because he's a very risk averse person. No, it's a joke, but sometimes it's true. Okay, simply lowest return, bigger, highest cost. Yes, you are right. So risk averse could not do business. Very good. Simply lowest return, bigger, higher cost. Okay, so I just only want to refine that when you're talking about return, you're talking about cost. The idea is only about the, benefit and cost, right? Now, how to estimate the RE or the KE? Anyone read the problem? Let's assume that you are able to do the Excel spreadsheet. You get the IRR of the project or IRR equity. Okay, just only do those kind of IRR formula from your Excel. Now let's go to get how you get the RE. How you compute the RE. Okay, if you are listed company in the US, if you want to estimate RE, how you estimate the RE? You can use, for example, the CAPM, right? So you measure the beta, you compare, you multiply your beta, which is measuring the market risk or systematic risk, which is the risk that you get compensation, right? Because this risk is a undiversifiable. You compare with the market risk premium, and then you're gonna get the risk premium of that investment or that security. In other words, I can use my ERI by simply take my RF plus the risk premium, where my risk premium, I use the beta multiplied by the ERM minus the RF, and this become my CAPM, isn't it? Okay, so my beta multiply my market risk premium, which is the ERM minus RF. I gonna get the risk premium, is mean additional return above the RF. If I want to know what is the total return, required rate of return for a stock I who has the beta, okay, and this one I gonna be able to compute my expected returns, and these my expected returns, I gonna use it as my expected or cost of equity capital, right? So I gonna be able to compute the cost of equity capital based on my CAPM formula. Okay, that is what you did it in the my capital structure class when you invest domestically. Okay, you are a US company, you invest in listed company in the US, and you're gonna be able to know what is your cost of equity capital. And this cost of equity capital, the beta here represent what? Is a beta equity or the beta of firm or the beta of asset? U beta taking into account of the capital structure of a stock I. This is a beta equity or is a beta asset? Beta of asset? No, it is the beta of equity. Because when you compute, when you run regressions to get the, do I have the, let me check whether I have a, everybody see my slides. So if I have the, I try to find out the beta, I take the excess returns of the company and excess return of S&P 500. You know how to compute the beta? I remember I asked you to compute the beta based on uh, the this one. This is the formula that you can use to identify and run linear regression. I asked you to use some Vietnamese a stock and compute the beta, and then I still remember that you find some interesting results on the beta of one sector, which is more uh, or less higher or lower beta, and then this is the way we take the beta. When you get the stock returns of Cisco and stock return of S&P 500 and find and get these beta, the Cisco here, you don't deleverage everything, right? So you just simply use the stock return of the company where the company has that level of debt, right? So therefore, you take the equity part when you run regression to get the beta. So your beta here represent the beta of equity. And this beta of equity would allow you to compute the cost of equity capital. Okay. If you still remember, long time ago, my capital structure class, you can also compute the unlevered beta, right? Unlevered beta, like you use Martin Miller's, you use the beta unlevered should be equal to the beta d multiply d over d plus e multiplied by 1 minus tax rate plus beta e multiplied by e over d plus e. Like it's like a formula of the WACC, right? And then you use the beta instead. You still remember? You have beta unlevered and beta levered, right? So now when you observe in the capital market, you observe the beta of equity or the levered beta. Okay, so it is the beta, the equity beta that we observe. This represent the levered beta. So you have already taken into account the level of debt that each company has. What is the final risk to the equity holder that you observe in the stock market by running regressions of that one? So once you get the beta equity, and that is the equity beta, basically. If you want to make sure that after you get levered beta or equity beta, you're gonna be able to compute the asset beta by deleverage it. Okay, so you can take, for example, the equity beta divided by 1 plus 1 minus tax multiply d over e. That is a way you can just use the beta u equal to the d over d plus e multiplied by rd multiplied by 1 minus tax rate plus e over d plus e multiplied by the re. You follow me? I don't invent these complicated formula. It's just only the WACC formula. And after the WACC formula, you can compute the beta U. They call the unlevered beta. If you don't throw my document away long time ago, or if you still have your ebook of the Burden Muscle in the capital structure chapter, you should have this kind of formula. Or if you Google, I Google it this morning to as the, you see my screen? You see my screen? So I just Google 5 minutes before the class from these Corporate Finance Institute. So what is the unlevered beta? Unlevered beta or asset beta is a beta of a company without the impact of debt. It is known, blah, blah, blah. It is once you get the equity beta, you're going to have this formula to be able to get the asset beta. Okay. Once you get the asset beta, you're going to know the unlevered beta, and then you can plug the leverage back, and then you're gonna be able to get the lever beta. See the gymnastic we are doing here, which is exactly what we do in this exhibit number 11. Okay, so let's go to my slide. Okay, Okay. You see my slides on the handout number 4, estimates project cost of capital in emerging market. So the projects, okay, they estimate the weighted average cost of capital of a project, okay. Just simply use this WACC formula. In the KE, they use RE plus beta E multiplied by RM minus RF. So basically just simply use the cap M, okay, plus SP plus CP. What is the SP? What is the SP? What the SP? What is the SP? Startup premium plus, oops, plus the CP. What is the CP? What is the CP? The CP is country risk premium. Okay, perfect. What is a country risk premium? It represents why you need country risk premium to compensate what? To compensate what type of risk? You use the CAPM to compensate what? You use the CAPM to compensate the CAPM to compensate market risk of the project, right? Or systematic risk. Okay, if you are US investor, you invest in the US. If you are able to quantify a beta, which is represent the market risk to equity holder, you're gonna be able to estimate using CAPM to get the compensation of holding the market risk for equity holders, right? When you plug the country risk premium, in addition, it means like you estimate that if I move from my US domestic country, I'm moving and invested in Vietnam, I invested in Venezuela, I invested internationally, okay? So what is the extra return I should add on it, okay? And this one is represent what? It represent the country risk premium. They estimate to compensate what? To compensate political risk of that country, right? So that is a kind of a proxy of political risk. What is the risk in addition if I move, okay, if I do the cross-border transaction that I'm US investor, I invest in Venezuela, and that it should be an idea of compensation that represent to compensate the political risk. Okay, so we're gonna go that later on how we address these, how we compute the country risk premium, which is not easy to do so. Okay, because the country risk premium I gonna discuss later on. Let's go to the simple CAPM. Oh, the startup premium. Okay, we come back later on. What is the startup premium? They explain in this exhibit. What is the startup premium? It means the compensation of what type of risk? It says that it is the the startup risk, the risk that you started to do, and so on and so forth. Okay, so you have different components of the required rate of return to equity holder when you estimate international cost of equity capital here. Okay, you use the simple CAPM, assuming that if what required rate of return investors should get if you invest in the US. If you are in Vietnam, you compute the beta of Wincom. You compute that if you are Vietnamese investor, you invest in the beta of the Wincom, what is the required rate of returns for Vietnamese company or that stock. But if you would like to know a project that Wincom will invest it in Cambodia, and you evaluating the international project cost of capital of Wincom company in Cambodia. What you need to probably need to adjust is additional country risk premium or the political risk premium in addition, okay? Because you're going to invest in Cambodia. What is the extra return you require to compensate the extra risk to the Wincom equity holder when they invest in Cambodia? And what is the additional country risk premium if Wincom decided to invest in the US when they are planning to have the VinFast in the somewhere in the US to produce the electric car vehicle? Do you need to put all those additional political risk if you invested in the US from perspective of Vietnamese investors? You follow me? Okay. So that is how we're gonna do, how we're gonna analyze it today. Is all exciting things, isn't it? All right. So how they get, first of all, now let's go back to the US. You are DuPont Conoco. If this project is located in Alaska, okay, let's assume that this oil field is located in Alaska. In that case, you don't need to go for adding any country risk premium because it's part of the US. So you can just simply use the CAPM. The problem that this CAPM, you need to estimate the beta of this project to equity holders. Okay, you need to get the beta equity to use in CAPM. Everybody follows? But since the project is non-listed company, they not even exist. It's just only the paper project. How you can estimate the beta? Very difficult, isn't it? So the case proposed the way they estimate the beta. Okay, let's read it together. In the first bullet point. Anyone can help me to read? Anyone can help me to read how they estimate the beta? No? Anyone want to, can you turn on your microphone and help me to read how we estimate the beta of this project? The beta equity of this project is estimated as what? The beta, let me take 0.94. 0.94, it's come from where? Anyone can have, which is estimated, Tung Kin Tan, can you say? You can just help me to type, very good. Can you read? I should want to hear your voice. Can you help me to read? So 0.94 is estimated. Can you help me to read? Tung Kin? can you make the microphone on? No, you cannot. You cannot unmute, huh? Someone yesterday. Can you come? I cannot unmute. Anyone know how to unmute? Can you try unmute? I'm not very good in Canvas. Anyone can come unmute? Oops. Dash G document selecting tick tick tick. No one can unmute? Yes? Can you? Yesterday someone said that they have to reconnect and put it microphone on. Chui Dan, Guyan, T Guak. Anyone can unmute? No? No one can unmute? Or you don't want to talk? Okay, never mind. I read it for Teng Kien Tan. Okay, Petrosuata equity beta is 0.94, which is estimated by relevering the average asset beta from a sample of U.S. oil refineries, Ashland, Tasco, Utama, and Valero Energy, assuming a capital structure with 60% debt. Okay, so everybody understand how they do this. Okay, first of all, if you don't do this, what else you can do, right? You have 4 comparables. Assume that these are good example. I don't have any idea whether is a good sample or not. These 4 company that they want to use it as a sample of the average firms in this industry, the industry that Petro Suwata is going to do with 3 phases of blah, blah, blah. Okay, assume they don't have any detail, but they use the comparable firms to assume that these 4 companies are the company of representative with the same average risk of Petro Suwata. Petro Suwata is located in Alaska, in the US, when they use only the CAPM. Everybody follow me? Yes. Then they observe these, they observe what? They observe equity beta of these 4 companies, right? They observe the real beta in the stock markets. When you observe the beta from the stock market, it means that you observe equity beta. Okay? The problem, or not the problem, you can say that, oh, I can use the average or the median of equity beta that I observe of this my sample of the 4 company as a proxy of equity beta of your project. Okay, you can do this way, but the case doesn't want to propose you to do this way. What the problem with this way? You just compute the equity beta of a group of company you are interested in, what, and then you compute the average or the median of equity beta that you observe, and then you get a proxy of equity beta of your project. What the problem with this? What the problem with these methods? First, the problem is the four company, they may have different debt level, isn't it? So the company may have, Ashland may have very highly leveraged, Tosco, if they are very low leverage, you don't know, because what is the effect that can affect of equity beta that each company may have from the effect of debt. Okay, so you can assume that on average of these, and second, you also don't know what debt level of the project, the debt level of your project. Not just only that each one has different debt, but your project may have different debt level compared to those four companies. Okay, so it doesn't mean that you cannot use it. You can still use the average or median of equity beta of your comparable firms. But if you want to take the leverage effect out and assume that the asset or the business risk of your project is similar to the business risk of those comparable firms, without the debt effect, what you can do is you convert your equity beta of each company to what? You convert equity beta of each company to the asset beta, meaning that these asset beta represent the business risk of that company, no matter they don't have any effect on the leverage, isn't it? Once you get these asset beta 1 of the first company, you have asset beta 2 of the second company, you have the asset beta 3 of the third company, and then you get the beta 4 of this company, and then you compute the average of asset beta of the four company, or you compute the median of asset beta of the company. Everybody follows? So in this case, they compute and they get the average asset beta of 0.38. 0.38. The beta of the asset is equal to 0.334, 38. Everybody follows? Everybody follows. You use the formula of unlevered beta to get asset beta. Okay, you observe lever beta from the market, okay, from the stock market, and then you compute unlevered beta of each one, and then you average it, or the median, okay. Once you get the beta of the asset, by the way, I have just saw there is a kind of a video. You can just have a look. This is what I just explained to you, just for fun. You can just have a look to revise, but it's nothing complicated. Just we have already learned it in my capital structure class. So after you get 0.38 of asset beta, and then I add leverage effects with the D of 60% back to my asset beta. And then I gonna have my equity beta of 0.94. Any questions? Is it clear? Is it clear to you guys? I don't say that you can average equity beta of your comparable firms. You can do that as well, but the errors may be more, or the assumption you use may be quite strong. For example, if the three of those comparable firms, they have the average of 20%, for example. If you estimate the equity beta of your project that have the debt of 60%, and then maybe you underestimate the equity beta. You follow? So to do this, you assume that the business risk of your company has the same as the average of the asset risk of your comparable firms, the business risk. And then you plug your debt later on. Assume that your project, you're going to borrow only 20%. In that case, the effect of your leverage, whether 20% or 60%, should not affect your assumption on your asset beta. You follow? Is it clear, you guys? Any questions? Please. You don't have any questions? Is it clear? Super clear? Okay, perfect. You got it. Everybody got it? Okay. So everybody understand now on how they compute the beta. Okay, so the next question that we ask is whether the company or the beta A, which is 0.38, makes sense. That is another type of questions because those are the US oil refineries, but the project is an oil field pipeline and refineries and so on and so forth. Okay, so now you understand how they get the beta of 0.94 with the capital structure of 60% and so on and so forth. Yes, perfect, perfect, perfect. Perfect from my side. I don't know whether you're perfect. Okay. Oh, very good. So we got almost the big part of the class today, but I still have other things to talk for the second part. Let's have a break of 15 minutes and then we come back. Yeah, perfect. So I I pause my recording. Sorry. Okay. So I repeat, they add the startup premium, okay, in addition to the CAPM. So the startup premium they used to compensate the startup risk. Okay, my question the is startup risk is is a systematic unsystematic risk or systematic risk? Is a startup risk is a unsystematic risk or systematic risk? Is startup is unsystematic risk or systematic risk? The answer is it is unsystematic risk. When it's unsystematic risk, is the risk that we have to take care. Okay, both of them we should to take care, but we cannot take care the systematic risk on the discount rate and unsystematic risk on the cash flows. So in this case, the systematic risk or the startup premium should reflect on the discount rate that proposed by the exhibit or by the case, or it should adjust it on the cash flows. Since the standard risk premium is to compensate the unsystematic risk, so therefore it should go to the cash flows adjustment. Okay, so how we incorporate it and should not should not adjust it in the discount rate, because the discount rate should take only systematic risk. Remember, like the way we use the CAPM, we take only the beta. We don't take the volatility or idiosyncratic rate or firm-specific risk, right? The beta is measure market risk, which is systematic. Okay, everybody know how to define whether it's a firm-specific risk or the systematic or unsystematic risk. So therefore, this is wrong. Adjusting the startup premium in the discount rate on the discount rate is wrong. We should not. Okay. So how can we adjust it in, if you know that the startup premium, so how that would affect to your project analysis into your cash flows? How we adjust it? How we adjust startup risk? How we adjust it? How we do it? How we incorporate this startup risk if it is important for your estimation? If you don't adjust, the idea is this one. Okay. Okay. So the startup premium should not adjust it in the KE. It should not adjust it in the estimating cost of equity capital. Why? Because it is unsystematic risk. Okay. So if you don't adjust it in the startup, what you can adjust? So you can use, for example, okay, so if you believe that there are some startup premium or startup risk that may affect, and that it may affect to the production, and that may affect to the, number, the amount of oil you can produce, or you can affect some of the cost on this, particularly only a few years when you start your operation. That's why we call startup, right? So that may affect the cash flow estimation here, that may affect the cash available for debt for the beginning of the period. For example, this one, these cash available for debt service in year 2000, 2001, 2002, you can assume and make adjustment on this if the startup risk may affect the cash flows from the first 3 years, okay, about 10% or 20%, and that how that affect the whole one. And you can make the sensitivity analysis based on this adjustment of your startup, but never adjusted startup risk in the discount rate. It is conceptually wrong. Okay, so since the risk under developing stage should be reflected in the cash flow numerator, not in the denominator. Okay, so we adjust the denominator, which is the discount rate, only when it's reflect to systematic risk. Okay, so now is political risk is more systematic or unsystematic? Political risk is systematic that affect to several projects located in the country or is very specific to this project. The answer is that the political risk is the systematic risk. Okay, so we adjust where? We adjust on the cash flow or we adjust on the discount rate? We adjust it on, I'm sorry, the discount rate. Yeah, so that seemed to be fine to me. Okay, we can adjust the CP, but now how we get this 6.67? So they use the bond yield spread, okay, represent an ex-ante assessment of country risk premium that reflect to the credit worthiness of the government. So basically, they use this as proxy. You understand what the proxy means, right? The proxy, by observing how the capital market, particularly the international bond market, evaluate the risk of the government on adjusting on the price of those sovereign bonds. Okay, so the higher risk country should have higher country risk premium, meaning higher bond yield spread in the sovereign bond. Okay, and then they use it as a proxy. Okay, so the problem that we have here is that sometimes, okay, not often, that the yield on the bond represent the government, which is also, this is the debt part, but we adjust this one on the equity equation, isn't it? Right? Because the RE or the KE is an equity, the premium attached to debt is can be different than the premium attached to equity. But never mind, we can make some assumption based on this as a proxy of the country risk premium to compensate political risk. Okay. And then they said, okay, 1,000 basis point look exaggerate, though I take 2/3, but why 2/3? We don't know. It just said that it's 2/3. Okay, that is the second one. They have other ways to compute the political risk premium, but this one is example, and we often use it by using the sovereign bond yield as a proxy of the country risk premium. Now, how the estimates cost of debt? Cost of debt they assumed to be 10%, even though the financial advisor think that the project can get the bank debt approximately 8%. The bond debt yield should around 8.5, but they use 10% for this. Okay. Now they have also in the real um, in the real world when you compute all these IRR equity IRR project, you assume one single discount rate for all the period. So if you believe that some of the risk of the project may change over time depend on the state of the project. So if you want to readjust the different discount rate, you can use the APV, for example, adjust the present value approach when you do this kind of evaluations, accommodate a changing capital structures. Okay, so We have already discussed about this. The base case 60% leverage, you get the IRR equity of 25.6%. But if I adjusted my KE or I compute my KE, I can be able to get the range of the KE where or the RE to see whether 25.6% still bigger than the the KE. But the idea that we are interested in is to ensure that the minimum IRR equity is bigger than the maximum RE. So if I use the sensitivity analysis, as we know, we use the sensitivity analysis by changing the leverage, and that would affect the different DSCR. You can do that, okay? And then you can also make some of those sensitivity analysis based on different type of change on the parameters on your cash flow estimation here, right? So now, how we can make to ensure that the scenario that you should make? Okay, let's go to part by part to see that what are the potential major risks that may affect the economic cash flows or the cash flows. Okay, so if you are able to identify the major risks, and then you're gonna know how to adjust to make the sensitivity analysis or scenario analysis by adjusting some of these number and then recalculate the DSCR or calculate the IRRE. Okay, so the cash flows projection here, you can make several scenarios based on your estimation. But right now, how I can put some parameter that I would like to change and to see how that affect to my Excel spreadsheet calculation for IRR or DSCR, how we do it. So you have to start, first of all, how you identify the risk. Okay, so everybody know how you analyze this. Like, why don't we do this together? Oops. If I want to identify some major factors that I would like to adjust it or make some analysis on my cash flows. Okay, can you just tell me what are the risks associated with this project that you believe is maybe important? Can you give me name of risk that you think is important? Anyone? We try to identify the risk. Can you give me any type of risk that you think that is important? And then I would like you to go for first identifying different type of risks. So you just take a piece of paper, you're gonna bring all information, any risk you can think of, and put it in a piece of paper. We're gonna do some, mind mapping and try to identify the major risk. Okay, because all these major risks would affect or tell you how you're gonna do some kind of minimum or maximum, and they get an idea of the range of if you change numbers, how that affect to your final decisions. Can you give me some risk that you think? After you give the risk, we're gonna assess risk together. Okay. Okay, I have country risk, currency risk, inflation risk, default risk, political risk. Okay, let's write it. Tuck, tuck, tuck. Where is that? Where is my PowerPoint? I have country risk or political risk. tick. Political risk. Oops, let me take some more small. Tick, tick. Let's take it. Okay, let's like this. And then I have different type of, do I have else? What else do you said? You say market risk, legal risk, market risk. Okay, I put market risk. I have legal risk. I have inflation risk. What else? I have several bull here. So let me check. What is legal risk, market risk, credit risk, currency risk, credit risk, credit risk. I have also the foreign exchange risk, forex risk. Okay, what else? Liquidity risk, very good. Liquidity risk. I have to liquidity risk. What else that I have not done it yet? Political risk, inflation risk, default risk. Default risk and credit risk is the same, right? Market risk, critical risk. Any other risk you have? No? No other? Okay, I can probably market risk. There are also two components, which is related to price and also related to quantity. And since these are can be not necessary, you know, important, they may not necessary with the environmental, so I can make the also environmental risk here. So what else? Liquidity risk, anything else? Supplier risk, very good. So supplier risk, supplier and that is can be also related to operational risk, right? Operation risk. Okay, what else? I see somebody type it. Technical risk, reputation risk, supplier risk, technical risk. A technology risk. What else? What else? So technical risk, reputation risk, environment, information security leakage risk, information leakage, information risk, information leakage risk. What else? I see technical reputation risk. Reputation risk. So when you have those kind of like a very big project, one that can be also related to the, you know, what we call the construction risk, or the something related to whatever we call the completion risk, that you cannot finish the project on time, for example. Does it mean that you cannot finish everything? So let's assume that we have all these identified risks, and now let's evaluate together, okay? And then try to see how we can do some what we call the uh, already we call the mind map. Okay, let's map together all these ideas and then try to assess and quantify it. So if it is small, we can probably, first of all, let's group it to see that some of these maybe that is more, you know, political risk, inflation risk is almost maybe the same type of cluster, quantity risk. These are also related to more macro type of risk. Legal can be also more macro. This one is more operational, where you have supplier problem, you have some information leakages, you may have some technological that may affect over time. You can have some, you know, more financial risk. To be somewhere here, credit risk, competition risk, the construction risk, completion, environmental that may affect for somewhere construction that may have the effect on this, and then the liquidity credit risk I make 2 times, so you may have some related to financial risk, which is can be probably closed to this kind of thing. So if I combine 2 or 3, I may be able to get some kind of you know, groups of information that may allow me to put it together. So based on your suggestion, I may have some, you know, issues that seems to me looks nicely. Oops. So I take these out. And then I have some line. I make some. Okay, I have this second, third. Hmm, that look nice. Oops. Okay, I have kind of 4 type of clusters that would probably allow me to analyze further. Okay, so I have, if you guys are okay with me, I can see some of those, group of different type of risks that may affect the project economics. So after these, after 1, 2, 3, 4, 9, 10, 17 identify risk that I have, now I should like to get some major one. What you think is should be kind of major among all these, and you think that it's important to address it in your scenario when you do analysis. Everybody see my map of the way I identify this. So if it's small, we're gonna take it small. Okay, if it's big, we're gonna highlight it. For example, do you think the foreign exchange risk is big or small? Foreign exchange risk. Let's go one by one. Forex risk. Do you think that these projects has big, very big, small, very small foreign exchange risk? So foreign exchange risk, meaning that the cash inflows, the cash outflows, they're gonna have in US dollar, how that affect to Venezuelan local currency, how that affect to the cost and the cash flow, the revenue, and so on and so forth. You think that it is big, small? So all the revenue, they're gonna sell the crude oil in what? In US dollar or in local currency? The revenue is gonna likely to sell in US dollar. They sell to Conoco, they sell to DuPont, and then sell to the international market. The majority of the oil will feed to the DuPont refinery, in the US. They're gonna sell it in the US, and most of the cost of producing in the platform all the capital expenditures that they use, they're gonna borrow project bond and indicated loan in also in US dollars, right? The only thing may be related to the local currencies can be some very local laborers and other, but if you are expat labor, you also pay them in US dollars. I would say that the foreign exchange risk for these specific project. Now, you cannot generalize, analyze all the projects in Venezuela in the same way. For these Petro Suata project, do you think the foreign exchange risk is high or is low? Yes, I agree. You all agree with me that it should be low. Okay. If it's relatively low, I gonna make it small and then I take the color out. Okay, because it's small. So political risk is high. I would say yes, because you are Venezuela, you have Chavez, you have also the case identify some of those very important even in the countries where they have like big issues on political risk. Inflation risk, inflation rate, I would say small, right? Because even they have high inflation risk in the country, it affects probably not much in the economic of the project, right? Because all the expenses related to the local currency or local economy is very small, okay? Because the crude oil that they extract, they're gonna sell. The legal risk, I would say that probably is very part of these already, right? Part of political risk already. So I would probably take some color, but not that, well, not that big. Oops, no. Okay, let's take it in some of these inside or a little bit overlap with the political risk. In this block, it seems to me that I can probably identify big political risk as one of the factor risk that I have to take into account. And then we adjust it in the systematic risk using the risk premium already. Okay. Let's go to the second one. Somebody told about market risk, quantity, liquidity, credit risk, and so on and so forth. That is some kind of, which one you think that is the most important in this second circle? If you want to identify major one, what do you think? It should be, what is you think that is about the major risk related to market risk? Or price risk, quantity risk, and so on and so forth. In the second box, second cluster, you think they can have the price risk, market risk, quantity risk. Do you know what the quantity risk means? Okay, in the market risk, you can have that effect on the fluctuation on the price and also the quantity that may affect the overall of the market risk that will affect the revenue of the company. Okay, what do you think that is the most important risk in that part? Oil price volatility. Very good. So I would think that this project is a huge, risk that we would should be able to identify, should represent these price risk, okay, which is part of the market risk and part of quantity. I think it should be small, right? And the credit risk, yeah, it depends on, but after you do the DSCR, you calculate the liquidity, all that. I would probably take it like this as important, but probably less important than the price risk. Okay, I have price, I have political risk. Everybody agree with me? How you feel? How you You feel my analysis. Nice, isn't it? You quantify some subjective thing. I don't calculate anything, but I try to benchmark. I can try to make the relative term to identify some major risks, and then I will analyze one by one. But I want to get some idea first. Okay, what are the major one that would affect on my and how that adjusted, and they identify afterwards whether it's a systematic risk or it is unsystematic risk, and then I will adjust it on my Excel spreadsheet. Good? You like it? You like my big my map? Yes, you like it. You can do so many other ways. Huh? I've just tried to help you that is one way to do so. If you work as consultant, we can do this. You can put some degree, like I put the scale of 1 to 5. If it's important, I put 5. If I'm not less important, I put 2 and 1. Same thing. But for example, last year I put some numbers. I said, okay, on the scale of 5, what you want to give, and then I gonna be able to identify this. But this time I put pictures because I like to change, so I do it as a picture like this. I first write everything I have in mind, and then I group it a little bit, and then I quantified it, I assess it. Okay, so based on this one, information linkage, reputation risk, alert technology risk, and so on and so forth, I would say that all these are part of the operation risk, isn't it? Right? Which is important. Okay, where other, I would probably make it a little bit smaller. Why I take it smaller? This is probably bigger. Why is it smaller? Because it seems like the project actually use very repute technology with know-how from experience from Conoco, and some people have been working in this business for a long time, has a very good reputation and technology they use. However, they may have some still operational risk that may happen, but I would probably keep it in probably orange, okay? And also I think the size is smaller, okay, compared to the one that we're talking about here. Everything is relative term, right? So I make it smaller because I believe that the partners, the joint venture they make, and the technology they use to construct are quite, at least in the case, they said that they have been already, for example, the environmental risk, they have some expert who have made all that, okay? And then I would think that the construction completion risk is almost the same, but I think it's probably also important, isn't it? Right? When you have all those mega project, you always have the risk, okay, that may affect. Let it take it as an important one, and then let's check which color. So I have. Probably red, but maybe let's red and other something like this. Okay, now after this, what I can do is I'm gonna try to identify whether it affect in the systematic risk, or it should affect on the cash flows, or it should affect on the discount rate. So I would think that the completion risk is very specific to the project. The over operation risk is also unsystematic. Political risk, obviously, I would adjust it in the discount rate because it's systematic. The price risk, obviously, that would affect on the cash flows, okay, because this is a price risk specific to this business of the company. But obviously the oil price in general, it should affect on systematic risk, okay, for other company. But in this case, is more specific on the revenue of this. I would adjust on the cash flows. If I'm able to identify all these, okay, I can even go back to my slide. I don't know where did I put it. Oop. The last part of this slide, so you can have it, you know, on the, I would not ask you in during exam, okay, just only to give you some idea that if you don't use 1 CAPM adjusted with the country risk premium, you can use some other type of model that some of those investment banker use to how to compute the international cost of capital, okay. So let's go to this. I think that I put it in the slide number 3. Do I have it? Yeah. So we can classify various type of risks in different categories. So the one that we can do it is a pre-completion risk, post-completion risk, sovereign risk, which is the political risk. The completion risk seems to, you know, very important factor when you have a very big project, when you build airport, those kind of power plant, the construction risk is important. And then it may have some delay on those and so on and so forth. Market risk or the oil price, in this case, or the price risk can be important. For example, if you compute you know, the for example, the quantity that they may not able to have enough oil to sell. As you can see that they have a capacity of 120,000 barrel per day. You take 365 days multiplied by 35 years. So you simply take 7.1% of the reservoir, after the specialist saying that in that basin, they have like 21.5 billion barrels of oil at least. So 7.1% using for this project seems like the you know, quantity risk, the resource risk may not be an issue. Technological risk, it seems to be low as well because it used proven technology in the upstream pipeline facility and proven Conoco technology. All right. So the timing seems to be of the delay. Obviously, it seemed like they said that they should have, you know, way to manage it. The price risk and the issue, right? The oil price are volatile, and therefore, shall the company hedge the price risk? Seems to be not so logic to hedge the whole revenue. It's gonna be super costly, and then I think that is the price risk can be one of the major risks of this one. And last but not least is about political risk, where you know, Venezuelan government may have a possibility that the government may, you know, change the tax policy, you know, reduce royalty, and then they can, you know, directly intervene in the project free cash flows and so on and so forth. That's why the project decided to not to keep the cash flow inside the country. They put in some of those offshore account and put all the money outside the Venezuela to mitigate this kind of Venezuelan government expropriation. They even make the the status of the project by taking 50.1% by Conoco and 49.9% by Maraven or PDVSA, because they want to avoid to call these Petroswata company or be treated as a state-owned enterprise. When you own more than 50%, you can consider as state-owned enterprise. So therefore, the intervention by the government still much easier to intervene in the company where you own majority in the company. In this case, the we should consider as a private company, not the non-state, because the private U.S. investors own more than the state owned enterprises. So that is a one small thing that you design organizationally to reduce, to mitigate the political risk. Doesn't mean that the political risk is zero, never, right? So if the government will take guns and go and try to get the asset, you can still do so, right? So all these would allow me to go, if I want to make some different scenarios and try to find out how that affect to my DSCR if I change, okay, what we can do is you can adjust your revenue based on your price level, and then you make all the price level again and try to see whether if the price going up and going down. But it seems like the estimate price that they make by using the price per barrel around 15 or 20 per barrel seems to be already pessimistic, isn't it? Right, because you can see the oil price fluctuations, okay, even after the COVID, and you can see that it seems like the price that they use not very aggressive type of assumption. However, you can still do some simulations based on the price change. Okay, you can do also different scenarios. This one, the exercise is probably more difficult because you have only the total revenue. You don't have a lot of expenses and so on and so forth. The estimation of scenario may be very rough. Okay, so now to the price change, you can change on the forecast price, isn't it? Okay, so if you don't use 12, if you reduce more, if you increase, how that affect to the calculation of your DSCR and your IRR and so on and so forth. Okay, you can also adjust it on what? You can adjust it on construction. So how that affect, how you can adjust it on the construction risk or pre-completion risk. The pre-completion risk is very simple. You can likely that instead of if you have some delay mean that if you cannot, okay, make your operation and generate your total revenue, so it's gonna delay all these revenue that you can generate at the beginning of the period, because the year will go up, right? To extend it, to take it longer, and you adjust it. Okay. And most of the time when you have a delay, you may have some construction price that may go up. Okay. And then you adjust it on this. Okay. Political risk, you have already done it. Okay. And then you can change the leverage, and then the leverage would affect on this and that. And all these are the issues that you can address and make it in your simulation, and make several type of simulation, and then try to ensure that your IRR of what you want to ensure is from the how to make the improve of your DSCR lowest DSCR to you're gonna try to improve your the lowest DSCR, not average DSCR. Okay, from the view of bondholder or debt holder. And then from the equity, you're going to want to ensure that your IRR equity minimum is bigger than the RE maximum. Okay, this is the key point of the analysis that we have done so far. Yeah. Okay, you can also do some chain or simulation on the KE because you can make the scenario on the KE to ensure that the estimation of the KE would change to what if you don't change, if you change your comparable firms and so on and so forth. Okay. Perfect. 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 I will contact the admin CFVG and try to, I will prepare, haven't prepared it yet. I will prepare short and easy quiz or exam, okay? Or I call the quiz. I have in mind to make some maybe only 2 or 4 questions, and I'm gonna try to manage to recheck the concept that we have learned together. I would say I would not know like calculation, meaning big calculation, huh? All the question that, for example, if you remember, we have, I share with you, I can upload where I can upload it. I can upload the did I have already upload? No, I have international finance. I have the file. I have case syllabus problem set. I can probably give you now before I forget. I can upload the problem set solution. So you have problem set solution that showed you the answer of those questions. But I try to not to do it in the exam because it may take time. But I just want you to know that you should know how to do it. Okay. And the I get a more conceptual question on the thing that we have learned together. Okay, in the class, that it should be up and it should be 5. When the estimated exam, when would gonna be? Let me ask the CFVG when they can organize. Okay, it should be 30 minutes or 1 hours. Okay, I give 1 hours. So since I don't know whether you have other exam or other classes, we will start to have final exam on May 22nd. So, but this one you don't need to go to the regular, not not a regular exam. It's just only a short quiz from me. I will let you know. I will let the CFEG to find out the date. I gonna prepare. I gonna write the exam or the quiz. I call quiz, and then it's gonna be probably 20 quiz of true and false, as I told you, and should be fine. I see this on calendar. Ah, okay. You have already calendar the May 22nd. Very good. So in that case, we do on the May 22nd then. Maybe they have already adjusted, already scheduled it on your agenda. That's great. So since I don't see your agenda, I cannot know. Okay, so this is very good news. So I know that the May 22nd, you're gonna have this kind of exam. So it's gonna be shorter than schedule because I decided to do simple exam. If you're okay, are you okay with the easy, simple exam? I suggest to have closed book because it's easier for you. It's gonna be super easy. So I'm gonna probably use true and false type of questions. All I discuss in class, I will ask. Okay, all right to be the what are the major concept that we have learned. Many of these were related to Peto Suhata case, okay? But you don't need to bring Peto Suhata case because I would ask only a general understanding, not precisely, what the name of project sponsor is would not be. You don't need to memorize it. I would say that as Conoco, as an equity holder, what would be, the criteria of the 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 Conoco shareholder, whether or not they're gonna invest, will gonna be depend on whether the IRR bigger by IRR equity bigger than the RE equity. And you say true, something like this. Make sense? Yes. So all the notes, all we have discussed should be able to handle it. Okay. I can ask you whether the uh, the asset beta does take capital structure into account. Answer would be false, like this. Okay, it's gonna be online probably. I guess I asked them to check what is the sanitary condition, the COVID conditions, and so on and so forth. Since it's still 22nd of May, so therefore we still have time to see the situation. But I let the CFVG to manage it. Okay, I cannot. They will confirm with you what type of those. Okay, but I can do more my the question I have in mind can do on site, can do online because it's just only 2 and 4 questions, probably 20 questions. Yeah, so I will give you some bonus points of when you come to class, attend the class, but most of you attend, and then it should be fine. Any questions? How many questions in 30 minutes? As I say, maybe 20. I'm not sure, maybe. But as I told you, just only simple questions, only simple questions, but people can still make mistakes. if you don't understand or you don't listen me. Yeah, but it should be fine. It should be doable. The idea for you is, I know that you are doing this master not just only to get a grade, right? To understand. Okay, your simple is our high mountain question. Okay, good. So, do you have any other questions? I can see, when I ask you a question, I can see the variation of answers. Some of them are not necessarily good answers. And then, hopefully that after being together in this international finance course, I hope that you learn something. Yeah, you don't need to learn everything. You have to learn something and don't forget everything. You should keep something in mind to be used in the future. All right. If you don't have any question, I just want to, I'm sad again to say bye-bye to you, and I hope to see you soon. If I'm able to manage for in the future to visit, I will let you know, okay, so that we can have dinner, lunch together. Okay. Can you set 40 minutes? I may give you 2 minutes per question. Yes, I can. 40 minutes or even 1 hour. Okay. Thank you. Thank you very much for your kind attention, your enthusiastic, you know, um, motivation to take class in the evening and weekend. Thank you very much for your participation, and I wish you a great day and hope to see you soon. Thank you. Bye bye. Thank you. Your course is very interesting. Thank you. Goodbye. See you. Bye bye.
You are currently the only person in this conference.